Welcome to the webinar series of Barjeel Geojit Financial Services that we have been hosting for the last few months on a regular basis. As you are aware that we have been talking on many themes and issues over the last few months for investors and to enhance their knowledge and information in order to take a well-informed decision with regards to their investment plans. One of the themes that has been coming up in the recent times has been the need for protection, how well protected you are, especially the pandemic situation has thrown up a number of issues, and we have been posed a number of questions by our clients in terms of how we should be approaching this and how should our investments in terms of protection be directed. And this is becoming a very important concern among many investors as well, clients as well. So one is with reference to medical coverage, one with reference to your protection that for you and your family that you have. So in this concept, what we've also seeing is that the last few months have also brought in a big change in investment behavior and thinking in terms of the need to allocate more towards savings and investments and to do a more better portfolio allocation for their long-term investment needs. It is in this regard that we have devised this webinar today on the theme of how protected are you with respect to your investments, and are you there? In order to take us forward with this seminar, we have an eminent speaker in our midst, Mr. Pankaj Gupta, who's the Senior Executive and Vice President and the Chief Marketing Officer of HDFC Life. He has been associated with HDFC Life from November 2014, and he also heads the Credit Life Business, Strategic Alliances, Digital Alliances, CRM, Corporate Communication, and CSR for HDFC Life. Prior to HDFC Life, Mr. Pankaj was associated with the Citigroup, ICICI, and TCS, and he has over 24 years work experience in the financial services sector. He is a product of IIT Kanpur and an IIM from and an MBA from IIM Lucknow. Over to you, Mr. Pankaj Gupta.
Thank you, Mr. Krishnan. Thank you, Mr. Shamsuddin, for this opportunity to come and speak with so many of you today. We are meeting under the clouds of COVID globally. And at this point of time, it is very important for all of us to see where we stand on various aspects of our life. I like to say that we have been living in what is called the VUCA world. So the world today is highly volatile, uncertain, complex, and ambiguous. And as we go further into this journey, things like COVID have made our world even more uncertain, even more complex, even more ambiguous, and even more volatile. What can we do as individuals to manage uncertainty in our midst? That would be the theme of my talk today. And given that I have spent over 24 years in financial services world, I will share some simple perspectives about what I feel can help us in manage this uncertainty around us a little better. When we are living with a lot of uncertainty, one of the true tests of any investment decision that we make is whether it lets us sleep better at night. So whenever you are deciding upon your investment strategy, do the sleep test as well, whether you sleep more peacefully after making that investment, or your sleep gets disturbed in the night and you rethink about your investment decisions. Given that as individuals, we have a lot of financial products, non-financial products that are available to us to invest, it is not a simple decision to take this call at any point of time. To ease that process of decision making, we have put together a simple presentation, which I will run you through. And this is more to establish the context of what I'm talking about than to go through each and every single point that is there on each of the slides, so that we establish a context to what we are talking about. And we understand various decision-making parameters that can be relevant as we go about this process. So give me a moment. Let me put my screen and you will be able to see the presentation that I will run you through in about maybe 15 to 20 minutes or so. And then we can get into some type of a question and answer session where whatever doubts you have, and to the best of my ability and knowledge, I would try and answer those as well. So give me a moment, please. So the topic of our presentation is life protection linked investments. Since all the products that we sell in life insurance typically tend to have a protection component as well, they serve a dual purpose of protection and investments. Given the uncertainty around all of us, one thing that we can do to take care of our family's situation is to lock in long-term investment strategy. And I will tell you why I am talking about a long-term investment strategy. When you look at various investments that are available to you, the popular investments tend to be fixed deposits, mutual funds, and for many of us, even investment options through life insurance. I will run you through how the various parameters look for each of these investment options and what role each of those can play in our lives. So savings accounts are the simplest financial products that we all start with, and they are essentially to give us the ability to do transactions. They are not targeted towards tax efficiency or augmentation of returns, etc., but just to provide us the flexibility to do transaction banking. Fixed deposits do give us return, and they are a very popular mode because of their simplicity and the ease of distribution. You can walk across to any bank branch and open a fixed deposit in almost no time. However, we know with fixed deposits, we do not get a life cover. Fixed deposits do not tend to be very tax efficient. And one other thing that you will realize when you get into a long-term investment strategy is that fixed deposits have a maximum tenure of typically 10 years. So in India, if you want to open a deposit with SBI or ICICI, the maximum you go is up to 10 years. Mutual funds are again a very, very popular mode of investing our money. And if you look at long-term objectives of return maximization, mutual funds do have a role to play in our life. However, mutual funds do not provide life cover. They tend to not force us to do any disciplined savings because you have the choice of continuing with your SIP or not continuing at any point of time. They tend to have some fund management charges associated with them. And now with the latest tax regime in India, the capital gains are also subject to income tax. We have bonds also have as one of the options, which in many ways are similar to fixed deposits. And then we also have options of investing in real estate and commodities like gold. The real reason for investing in these instruments is often need or the preference for a certain type of a real estate or a preference for a certain type of a commodity like gold besides the investment component. So these get into the more mix of rational and emotional decision. So these also, because of that reason, play a role in our decision about investments and savings. Though of course, when you look at the liquidity of these investments, the liquidity is not very high. The tax benefits typically are limited. There is generally a taxability, and they need, in general, if you are savings oriented, some large allocation of money. And probably you also need, if you are really thinking about investment as a strategy, thinking about how to protect that from adverse situations like theft, etc. When we talk about life insurance, this is one instrument that helps us meet our financial objectives, whether we survive or not. So if we are doing some savings through life insurance for a certain goal, it might be the wedding of our children, it might be their education, it might be our retirement planning for ourselves or for our spouse together. One advantage of life insurance, which is not there with any other of these instruments, is that whether we survive as the breadwinner or not, the objective behind which we started down that path of savings is usually met because of the life insurance component that is embedded in almost all of these products. The other reason is most governments, including the government in India, gave a favorable tax treatment to life insurance. And that really helps when we are talking about really a long-term strategy of investment, how the tax component plays out. It has a very large role. One thing which is there with life insurance is that these tend to be less flexible and not as liquid as, let us say, a fixed deposit. One way of seeing that is that it forces us to do long-term disciplined planning. Any instrument which is highly liquid, it means that the money is available to us, but it also means that during an impulse phase or during some other perceived need, we might break that investment. And that may mean that the longer term objectives that we have for selling or rather having that saving style are not met. So life insurance, because of the nature of the long-term planning, help us do those disciplined savings over the really long term. Here is a comparison of various instruments that I talked about. And as you can see, life insurance does have quite a few of the strengths that are not there with the other instruments. But yes, other instruments do have a role that I spoke about, and I will also refer to some of those parameters that you can use to decide your investment strategy at any point of time. Here again, I would want to highlight one or 2 points in particular. When you look at life insurance, towards the right hand side, you will see what we are calling mitigation of reinvestment risk. And I will give you an example of that. If, let us say, you wanted to save some money to provide for income during your retirement years, and you decide that the fixed deposit interest rate is 6 or 7%, I will save for, let us say, in a 10-year FD, and then again I will do another 10-year FD, and then I will go for returns from the final proceeds. So what is the reality of this type of a cash flow? One, the 10-year interest rate that you have today is certain only for the next 10 years. Even if you were to go for a 10-year FD, you have the certainty of that interest rate for the next 10 years. After 10 years, what is going to be the interest rate? Nobody knows. And I will show you a couple of data points after this slide to establish in your mind what has been the trend on those interest rates. So one, if you wanted to invest and for another 10 years, after the first period of 10 years of your fixed deposit, you do not know what is going to be the interest rate at that point of time. Finally, if you have saved for 20 years and then you want to get the returns after 20 years, you also do not know what will be the returns for withdrawing that money after 20 years. So this is what is called the reinvestment risk, where while for the initial period, you know the interest rates, you do not know the interest rate for the longer term after the initial period of the product is over. One of the products that we will talk about later in these slides is what are called non-par products for the longer term. And in one of the options, the interest rate can be known in advance for up to 49 years. So the product can be taken by somebody as old as at the age of 50 until the age of 99. You know for sure what is going to be the return that you are getting. Now, a couple of things are all over in terms of the media headlines. So I would just give additional context to that. A couple of weeks ago, I saw news about Germany, where if you wanted to keep money in euro, you had to actually get negative interest rate from the bank. That is the direction in which interest rates have moved actually globally. Even in India, while the interest rates are not near zero, you will see in the next few charts how interest rates have moved in the very long term. This has been a trend in the Eurozone, in the US market, in the Indian market, that the long-term interest rates are towards a declining path. If 30 years ago, if I had saved some money, I would assume that I would get a return of 12 or 13%. And if I saved 1 crore, I would get 1 lakh as an income on a monthly basis. Today, probably our thumb rule is that we will get 6% interest rates. So the point I'm trying to make is that there has been a movement towards lower interest rates globally. Lower interest rates are actually very good for the economy in general, though not very, very good for the savers who have saved money and want to live out of the returns. So probably low interest rates are good signal, but how they impact us as savers, as investors, is something that we have to analyze more carefully. The other thing that you will see with COVID is that our business life, our professional life, our job situation is no more as certain today as it was probably 6 months ago. Because the impact of COVID is still panning out, how the job situation is going to pan out is not very clear. And that creates additional uncertainty in our lives, besides the uncertainty presented by low interest rates, where our income gets impacted ultimately. And finally, COVID also has impact on mortality as well as health costs. So our cost may go up, and many of the breadwinners, if they do not survive, they have to depend upon, or the family has to depend upon, the savings that they have already made. This chart shows you how different types of financial savings instruments have panned out over the last couple of years. If you see deposits in scheduled commercial banks, they have been at a very, very high level compared to life insurance as well as mutual funds. However, the graph is more positive and more stable for products like life insurance than for products like fixed deposits, because as consumers get more comfortable with taking a more sophisticated financial decision, they go beyond the simple and well-distributed products like fixed deposits and look at other financial solutions that are able to take care of their needs in a better way. So this is a summary of what we are trying to talk about. We want to be prepared for the unexpected. We want to protect our family from the consequences of various types of uncertainties around us. And we want to do that in a way that our real purchasing power, our real financial status is protected in spite of the risk that we all face. This chart talks about, or rather gives some data to you about the movement of interest rates. And I also, before coming for this call, I also noted down certain data points. So currently in the US market, if you look at CD, what they call certificates of deposits, the rates are in the range of 0.1 to 0.25%. That's the rate. To give you some context, the 1-year rate for certificates of deposit in the US was 8.5% approximately in 1985, about 8% in 1990, about 5.5% in the year 2000, and about 2% in the year 2002. So we have seen rapidly how the 1-year certificate of deposit rate in the US has gone down from 8.5% in 1985 to just about 0.1 to 0.25% range now. Similar data I collected for the Indian market. Indian market had roughly a 12 to 13% return on deposits in the 90s. And I checked in the morning today how state bank FDs are paying interest rate right now. So they are something close to 6% range for most of the tenors in the current juncture. So in the last 25 years or so, both in the US and in India, interest rates have gone down by about 6 to 8 percentage points. And this again is given in a more holistic manner in this graph in front of you. But the data that I'm quoting is something that I collected in the morning today. And that is also bringing out the same point in a more simple manner, how in the last 25 years or so, interest rates have gone down by about 6 to 8 percentage points. Now, we do not know how the interest rates will pan out in the future. Next 10, 20, 30, 40, 50 years, we do not know how the interest rates will pan out in India and globally. However, can we do anything about it? That is the conversation we will have. So this is something that I also talked about. On the right hand side is something that we are talking about, how to lock in long-term returns for your investments. So one of the options that we provide as life insurance companies are called what are called non-participating products, where a fixed amount is paid to the policy holder and the returns are guaranteed to the policy holder at the outset of the policy. So irrespective of what happens in the external world, your returns are guaranteed for the entire life. So as I gave the example, if somebody were to buy that policy at the age of 50, they will know what exact money they will get till the age of 99 in the lifelong option. And look at what are the risks you are guarding against in this scenario. One is the sheer risk of interest rate changes. You're also guarding against the risk of reinvestment of your money at a subsequent point of time where the interest rates might be different. Thirdly, as per the tax regime today under the section 1010D in India, these returns are exempt from income tax. Now, tax regime may also change in the future, but the way we have seen in the past, normally those tax changes apply to investments made after the date of that law coming into the picture, or the tax rate coming into the picture, rather than to the investments already made. So more likely than not, these are going to remain tax-free in your hands in the future as well, if you were to invest at a time when they are free of tax. One thing I want to highlight about these products is that these products do create a lot of impact on the life insurer. So the profitability of the life insurer is highly sensitive to the interest rates. If the interest rates at which the life insurance company invests the proceeds, they still remain subject to the risk. So our risk as customers or investors is actually getting transferred to the life insurance company. And life insurance companies, some of them have a mix of products where different types of cash flows come in different time periods in different quantums. So part of the interest rate risk for the life insurer, particularly for those life insurers who have a very balanced product mix, are automatically immunized. Then it also needs a lot of financial savvy on the part of the life insurance company to make sure that the cash flows are managed over such long periods of time. So the company that is offering such products to you needs to have a very balanced product mix so that part of the cash misflow or cash flow mismatch is managed by the product mix itself. Secondly, the financial savviness of the company helps manage the remaining risk. And finally, the balance sheet and the solvency situation of the company has to be strong again to give such guaranteed interest rates for such long periods of time. So essential point is that with strong partners in life insurance companies, we as investors can transfer our interest rate risk from our hands and our portfolio onto the life insurance company. Another example, another benefit of such long-term products that is not often spoke is, since the product is distributed once, there is a cost of selling the product. When you take a really long-term product from any distributor, actually the per year distribution fees that you want to allocate to that investment becomes much smaller. So if you were to churn your portfolio every year versus keeping that investment for a very long period of time, you can see how you will save by way of lower distribution or the churn costs also. So that is one thing that I also wanted to leave here on the table for you. So again, to summarize, what are the benefits of the non-par product in particular that we're talking about in the life insurance context? There is a tax benefit on premium paid as well as on the payouts. Your payouts are guaranteed for a really long time. You get life cover alongside, and it is a simple product where in probably one page, a salesperson can explain to you all your cash flow that are going out, as well as all that you will be getting at whatever periods of time. So this is one example of how the product works. If any of you is interested in more detail, obviously Barjeel team is there to help you do that, any of their offices and people, and you can get to know more about how the cash flows pan out. The essential idea is that you pay for PPT, which is the premium paying term. You pay some annual premium, and then after a certain point of time, you started getting returns in different structures, in different types of cash flow streams based upon your needs. And there is enough flexibility so that you can choose your investment horizon and the amount of cash flows as per your need. So again, a summarization, multiple options available. Even if there is a death in the family, unfortunately, the family is protected. You can also think of it as a retirement product. While it is not called an annuity product, it effectively works as an annuity product. And it is ideal for those who want to think of it as having an alternate source of income in retirement. So many of us, the type of job that we work in, we may or may not have pension available to us. But if we can plan our investments in the right way, it effectively becomes our lifelong alternate source of income, acting something like a pension. This slide talks about the type of protection gap that we have in India. What is meant by protection gap is, if as a country, India needs to be insured for 100 rupees, then the gap is 92.2 rupees. So only 7.8 rupees of sum assured has been taken in India on an average for every 100 rupees that is needed. So what is the sum assured need? Sum assured that is needed, that depends upon our responsibilities, that depends upon our future earning capacity, that depends upon our other sources of income and assets. But when we look at it in a holistic manner for the country as a whole, the protection gap is something like 92.2%. It is a staggering gap. It talks about the need for all of us to think of protection as part of our investment strategy and overall financial strategy. If you look at the number of policies sold, if India has a working population of something like 17 crores, if we exclude a certain market which is probably not yet ready based upon the disposable income they have, we still have about 7 crores of market, and out of those, a minuscule percentage is taking life insurance policies today. So huge gap in terms of the need versus actual utilization, and primarily coming from the lack of understanding of the product and the lack of distribution avenues. Again, why we are talking about the non-par product? Because it removes some of the ambiguity, some of the complexity around life insurance products that have limited the distribution. And it also addresses a very valid need in today's highly VUCA world, highly uncertain world, to reduce a level of uncertainty in our lives. So most people are underinsured, that goes without saying, given that the extent of underinsurance in the country is something like 92.4%. So most of us are underinsured. Human life value is one of the ways of calculating how much of insurance we might need. And that depends on the savings, liabilities, and income profile, as I mentioned. I am at the end of my presentation, and I would now stop sharing the screen and come back and talk to you. What I wanted to again say here at the end is, we are living in an uncertain world where our health situation, our job situation, our asset situation, all of them are going through a lot of flux. We are also living in a world where various types of financial instruments are available to us, and they do serve different purposes in our life. But one of the primary objectives that we can keep as part of our investment strategy to say that we want to minimize the type of risk that we are taking in at least one part of our life. What we cannot eliminate as risk in our life, we cannot eliminate. But can we eliminate in the interest rate risk part of our life? So that has been the purpose of my talk today, to tell you that there are products and solutions available today which are effective from a cost perspective, from a tax perspective, and from the long-term reinvestment risk perspective that you can consider to plan your finances better.
Thank you very much, Mr. Pankaj, for that short and precise presentation. I think we've already got a few questions that have started to come, and one of the a basic question that I would like to start the whole session or this Q&A session is how much of insurance do you think a person should have, for he and his family? What is there a sort of a proportion, or is there some sort of a mix? And considering especially the fact that this COVID crisis has come about, how should one approach insurance with respect to the medical part of it as well?
So human life value is the right way of going about it. And when you look at your own personal life insurance need, one way to think about it is, for the next how many years your family is going to be dependent upon you. So I'll give you my personal example so that it is easier to understand. I have my wife who is a homemaker. My daughter is 16 and my son is about 11. I expect that my daughter will start going to university in about 2 years. She will study for probably about 6-8 years after that. So she will be financially independent maybe in the next 9 to 10 years. And my son will be financially independent in maybe about 15 years. So when I'm talking about my dependents, other than my spouse, I'm talking about having to plan for the next 15 years till my children become financially independent. So for the next 15 years, the other thing I would see is how much money do I need to reach the point where my children are financially independent. And if I want to reach that point, what is the amount of money that is needed? So let us say I come to a number of 5 crores or 10 crores is what I need in the next 15 years so that my family becomes financially, or children become financially independent. Then from that amount, I would subtract what I have already saved. So if I've already saved 10 crores or 5 crores, or whatever number, I can reduce it from the 15 crores and say that this is the remaining amount that I need to be saving from here on to provide to my children. So that is the minimum life insurance that I would say I need. Then I need to talk about my spouse's situation. If I do not survive my spouse, if I have her to pass away before her, then how much of an income do I want to give to her? And that income, as we saw in this example today also, in India is something like 6% annually. So if I want to have her an income of 1 lakh per month, then I need to leave an additional 2 crores or 3 crores for her. So these are the simple thumb rule that you can use, which will depend upon what are your net assets, what are your liabilities, and what are your income streams that you have, so that you come to the remaining balancing amount that can be the life insurance requirement. I have given a very simplistic answer. I have not taken inflation into account. I have not taken potential of your spouse to start earning, etc. Maybe any other something like a pension that you might get. But yes, this is the way to start thinking about it. Oh, what are the responsibilities? What are the assets? And what are the income stream that you have right now?
Wonderful. Thank you for this that update. There is a question that is coming up in summer. Is it possible to buy a pure term cover plus investment product from a life insurance company?
Yes. So almost all life insurance products, except for maybe pure annuity solutions, they have an insurance component built in. So you have to get to that sum assured that we are talking about. Is the sum assured enough as per your calculations and needs? And the remaining amount obviously is a savings component. So you have to look at the sum assured part through whatever financial instrument within life insurance that you have gone for, par product, non-par product, ULIP, or whatever else you might have chosen, so that the sum assured is up to the level that you need.
Okay, thank you. There's also a question that is coming up in the sense that how to compare the private life insurance with that of the with the insurers that are from the government side, typically LIC. So in terms of comparison, how do all insurance companies stand? Are they with each other, or how do you look at it?
So India has 24 life insurance companies. One of them is no more very active. So effectively, we have 23 active life insurance companies in India. One of them is LIC, and the remaining 22 active life insurance companies are in the private sector. Now, you also look at the banking world as an example of thinking about it. In the banking world, you have public sector banks like State Bank, Bank of Baroda, Bank of India, etc. And then you also have the private sector banks, including HDFC Bank, Kotak, ICICI, etc. I'm talking about the Indian market. So both have their role to play. I would say that when you are looking at a life insurance solution, the choice between a public sector or a private sector company is more dependent upon your particular need for a product type of a solution, coupled with your assessment of the financial strength and the brand of that provider. I would not go on to say that all 23 life insurance companies are equal in India, but I can say that the top 3 or top 5 companies in India are fairly strong in terms of their management, their brand, their book, and so on and so forth, so that you can reasonably choose from any one of them and be fairly assured in your own mind. Other thing I want to highlight here is that the regulator is extremely careful about the capital situation, the solvency situation, as well as the investment strategy that each of these life insurance companies employ. And because of those regulatory guidelines, the pool of investment that is going out where your money is invested is typically invested in
Hello.
giving of whether you go for a public sector company or a reasonably strong private sector company.
Another question is in terms of medical tests and requirements that is required. How does one deal with it from being an NRI perspective?
I will request my colleague Rahul to step in here. If Rahul, if you are on the call, if you can step in and talk about that.
Right. Thank you, Mr. Krishnan. Those facilities are provided, as per availability, and more, I think, can be handled, on a questions which are coming in on this on a one-to-one basis. We'll be able to, clarify on those, knowing exactly where they are placed and how can we support.
Sure. Because there are a lot of questions that are come on the operating terms of a policy, like payment of premiums and other things. I can assure the audience here today that we will take these questions and come back to you and answer those queries on a one-to-one basis, because these are specific questions, and we just would like to take certain topical issues that will be of interest to everybody. Can you, Mr. Gupta, now the question is on this guarantee product that we are talking. How are you able to, the question is that how are you able to guarantee this sort of a return to an investor, and what is the sort of the fund management that goes behind this sort of a product?
It's a very good question, and I'm happy that you have asked this question. I alluded to this in the course of my talk, that a life insurance company needs to have a balanced product mix if it were to offer such long dated products. So without getting into too much of detail, which may be of a competitive nature to us, what I can say here is that we have various products where the cash flows balance out. So for example, in this product, we are going to, in a non-par product, our liabilities are going to pan out over a very long period of time. Do we have another set of policies where the cash flow is exactly the opposite? So that is one way of thinking about it. The other is, there have been times in the past where for a short period of time, certain long dated instruments have been available that have enabled us to lock in interest rates for long periods of time. And those investment opportunities, we were pretty proactive in planning for and executing, because we knew that we have this type of a product that we can take to the market and profitably sell to our customers who will get benefited by it. Thirdly, there are other tools like FRAS and other options and so on, which enable us to further immunize the risk in the portfolio. And finally, you have the balance sheet strength and the solvency that gives you additional cushion. So this four-step process enables us to offer such long-term interest rates in spite of the challenges that are there in the overall environment.
Thank you. There is another question in terms of, are there any differences between an NRI and a resident when buying a product and tax during payout?
Again, I would expect or request Mr. Rahul to say something on this. Rahul, if you can.
Sure. So as far as this product is concerned, the taxability is not impacted by resident nature. The taxability on these products, again, as per prevailing rules, is more to do with the structure of the product, and the payouts in these products are, and specifically we're talking about the product that Mr. Pankaj had already referred to. The payouts are tax-free under the basis of a section called 1010D of the Income Tax Act, which is largely related to insurance products. So short answer, it doesn't really depend on the resident status of the client.
So let me just give an additional context to that the different tax regimes are there globally. So depending upon which country you live in and which country you are a resident of and which country the product itself is sold in, based upon this combination, there could be different scenarios. So ultimately, if you are taking a tax decision, please do consult your tax advisor as well, because your individual situation might be different from the usual situation.
Yeah, one specific question is, are pandemics like COVID covered by insurance companies? For example, HDFC Sanchay Plus.
Yes. So whoever has already purchased our policy and is under cover today, for that customer, COVID is also covered as an event which will lead to our honoring the claim, subject of course to satisfying all the other requirements. What is happening for the new customers is, for the new customers, we are taking a declaration that they are not suffering from COVID or they have not been exposed to COVID when they buy it. But somebody who has already bought it, and at the time of purchase, there was no COVID. Honestly, 1 year ago, if you bought the policy, there was nothing like COVID that anybody knew about the way we know about it today. So that is covered even in the current policy.
Wonderful. How do nominees benefit in case of an unfortunate event does happen to an investor? How does that process work? That's a specific question on that as well.
So in the illustration that we showed, we talked about the sum assured. And what happens is, if the investor or the buyer were to survive, they get some type of cash flows. If they were not to survive, they get a certain type of a sum assured, which is calculated based upon the formula. So if I remember correctly, in the 1 lakh example, the sum assured could be anywhere from 12 to 22 lakhs or something like that, depending upon when the event happened.
I think that pretty much sums up most of the questions. There are, like I mentioned before, a lot of questions in terms of product comparisons and in terms of product related issues like non-payment of premium and how does those affect the continuity of a policy, etc. Please note that we have taken a note of all these questions and the respective, and we will pass it on to the required, to the representatives who would then come back to you and give you the necessary inputs and the suggestions in terms of those queries that you may have. At this moment, I would thank Mr. Pankaj once again for sparing his valuable time with us. And I would now request Mr. Shamsuddin, our Director of Barjeel Geojit Financial Services, to formally propose a vote of thanks. Mr. Shamsuddin, please.
Good morning, Mr. Pankaj, Gupta and team and all the participants of the webinar. In fact, we are seeing a different scenario I am telling that aspect to the information of Mr. Pankaj Gupta also. Before Corona, that interest in doing some kind of participation or invest in the insurance was not very active. But what we are seeing today, people are showing so much of interest because of the Corona pandemic. But it is there late. As you said, if they already have taken, there will be coverage and everything. But the thing is, from the slides and the presentation you made, we all reached in a conclusion. If insurance coverage is a must for everyone, compared to the world presentation in the insurance or coverage in the insurance, either citizens of the other countries, ours is very low compared with other countries. So what I'm saying is that people are showing so much of interest. So this kind of webinar definitely help, but we have the responsibility to reach the people more aggressively, because now people cannot move like before. So that interest among the investors, among the non-resident Indians can utilize. So that is one of the aspects. I'm telling ourselves has taken a serious decision on that. And from the presentation, another thing everyone understood, the situation in India without a regular income or proper planning for our future, it will be a difficult situation for each and everyone. So this kind of participation, it will be very useful. Now it is, I think it is the 8th webinar Barjeel is conducting. We will conduct in future also this kind of customer education programs. And I'm very happy, more than 250 attendees were today this webinar. I express my sincere thanks all our customers who attended, and so many guests also attended in the today's webinar. Each and everyone, I request you will get the invitation in the future also. Please attend the future webinars to educate investors. I express my thanks especially for Mr. Pankaj Gupta for making us a wonderful presentation, a convincing presentation. It will be very much helpful for, I was watching as not a part of Barjeel, I was watching the presentation as a layman. From that I understood it was very convincing and very effective for all the investors. I am very happy in it. I express sincere gratitude on behalf of Barjeel as well for making us such a presentation. Also, I express my thanks to Mr. Samir, Rahul for arranging this presentation and presenting this webinar. Thank you all once again.
Thank
Thank
you,
you. Thank you very much, Mr. Shamsuddin.
It has been a pleasure. Thank you.
Thank you very much. Thank you, Mr. Pankaj. Thank you, Rahul. Thank you, Samir. Thanks a lot.
Thank you so much. Thank you, Mr. Shamsuddin. Thank you. Thank you, Krishnan. Thank you. Bye-bye. Thanks, Pankaj.
In the last 25 years, the returns on various financial asset classes like bank deposit, gold, and real estate have multiplied several times. But there are a few select investments in the Indian capital markets that have had the potential to appreciate exponentially over 100 times. If you had known this at the right time, you would have taken the right investment decision, which is precisely why you need an expert's validated advice when it comes to investing. Welcome to Barjeel, one of the few SCA-approved financial intermediaries in UAE. We are wealth builders, guiding customers since 2001. We have serviced over thousands of them till date, and today we cater to large segments across investor groups. This speaks about our enormous goodwill and their undiluted trust. And we have earned that trust by telling, not selling. We educate you on the investment opportunities that are ideal for you. We then help you make an informed decision, impartial and unbiased, keeping your long-term goals in mind. And with us, everything is long-term, be it commitment, relationships or success. We offer comprehensive insights across a wide range of products through a holistic approach. We ask you the most important questions, the answers to which will help you focus on your investment objectives. For example, you work for over 30 years. Are you saving enough for the next 30 years? For life goals like children's education, your daughter's wedding, or your retirement. Think about it. You work hard to earn your money. Does your money work hard enough for you? Barjeel, let's build your future. Come, let's talk.